As we look at this presentation today from a CattleFax perspective, our goal is to really cover four main areas. As we look at this from my standpoint, I'll talk to you about the first two bullet points, really give you a projection of what we see in the cattle and forage markets over the next 12 to 18 months. We'll talk about specifically our expectations for supply and demand relative to the cattle and beef markets, and we'll touch a little bit on competing meats. Then Mike will come in and finish up our portion of the discussion, highlighting some margin expectations relative to the cow-calf segment, but also explore profitability and risk management strategies for cattle producers. Then at the end, our sponsor, Lanco Animal Health, will provide a message as well. And it's through their support that we've really been able to do this webinar now for multiple years, going consistently strong with them as a partner all the way through. We really appreciate their support, and so Dr. Mark Hilton will be giving us a presentation towards the end, a short message from them as well, and then we'll wrap up with questions. As we dig into this discussion though today, I want to really highlight and start out talking about the markets by highlighting the supply situation. I think there's been a lot of information out there in the marketplace today relative to the Cowherd expansion that's going on top of the record high pork and poultry production. And I think when we talk about what supplies look like in this market environment and what that really means to us from a setting as we look at the markets and try to carve out our own expectations, is we really need to look at it from the standpoint of profitability, weather, and input costs. And as we break those three things out, we need to understand that the cow-calf segment, on average, has been profitable throughout the majority of the 2000s. Obviously, this last year was not near as good to the cow-calf segment as it was just a couple years ago, but overall, on average, the cow-calf segment has remained very profitable throughout this window, and Mike will highlight some of that even in his own presentation. Weather's been a different story. Really, weather's only been supportive from the standpoint of herd expansion since about 2014, about the middle of 2014, and the weather outlook as we look to 2017 is probably going to be very similar to 16 in a lot of ways, in that when we look across the countryside, we're going to have areas where there's going to be drier conditions, areas where there's going to be wetter conditions, but on average, not necessarily detrimental to the larger expansion picture. As we think about input costs, those are going to continue to come under pressure, likely not as dramatic of price declines as we've experienced over the last 5 years, but not be in a situation where we see prices necessarily from an input cost perspective getting out of control for operators. The profit picture is the one that's likely to change. We saw it change in 2016, and we're likely to see profit and margin go under some more contraction as we work through 17, 18, and 19. But what we need to recognize is just because margins are turning and margins are getting compressed at all levels of the production segment, once the factory starts increasing production, it's really hard for it to slow down. As we look at this, I think you can see that very clearly as we talk about feedstuffs first and foremost. And what we've seen is we've been able to realize big cross breaks all across all the segments. As we look at that, you can see the huge break we've done in corn prices, same thing in the lower left-hand axes with hay prices, but going forward, we're not going to see those get away from us right now. And you can see very clearly our projection as we look to 2017, very consistent prices as we look at the range on a futures basis, basically between the $3 range. Upper threes to low threes is going to capture the majority of the price move that we expect in the corn market this next year. And right now that's based on a very much trend line yield. Nothing from a weather standpoint says that we should expect anything dramatically different as we look at this, and that is a weather-adjusted trend line yield. As we get more spring and summer weather predictions under our belt, we'll likely be adjusting this yield appropriately. But no more than we know today, trend line's all we can assume. As we look at the hay production model, again, looking at a very stable hay production picture with that blue line, right there around 135 million ton. That includes both alfalfa and other hay prices. But what we should note is the price trend is still coming under pressure. on both of these markets, whether it's hay out from alfalfa standpoint or lower quality hay. As we look at it, what we need to understand is there's still a lot of stocks sitting around farms today. There's an abundance of forage out there. And so as we think about this factory, there's nothing from an input cost perspective that's going to limit us. Now, the big risk is if we have warmer, drier weather, and we'll need to keep that in mind. If the weather turns, it could turn this forage situation, and most notably the pasture situation, and cause a deviation from what we're used to seeing. And when we talk about these effects, I think they're largely being seen across the countryside today. When we talk about the growth in the factory, the growth in the cow herd, we're really looking at three main metrics, and each one has a little bit different time interval to it. Of course, the first two things we're looking at are how many heifers and how many cows are we sending to town. And what you'll see is, as we look at this number based on a percent of fed slaughter, we're seeing numbers that are some of the lowest we've seen in recent history. In fact, heifers as a percentage of total slaughter this last year was right around 31.9%. And that's significant from the standpoint of that's the lowest percentage of the fed slaughter that's been made up of heifers since 1974. Last year was a low number as well. And so what we've seen is over the last 2 years, a large number of heifers entering the cow herd. When we talk about it from a cow slaughter perspective, we've not been sending very many cows to town. When you look at 2015, which is this blue line, that was the lowest percentage that beef cows made up of total cow and bull slaughter on record. 2016 was higher than it, and really very similar to a lot of other expansion years when we consider where it's been from a seasonal standpoint. But that culling rate, even in 16, averaged as one of the second lowest in recent history. And so as we think about this, we're bringing in a lot of heifers right now as a percentage of the total fed mix, and we're not killing very many cows relative to the inventory that we have available on U.S. farms and ranches. And so as we look at this expansion, we're still expecting very large herd growth as we look at this January 1, 2017 number that's going to come out from the USDA next week compared to last year. Now, a lot of folks are asking, okay, that's great. What does expansion look like going forward? And that's where we can really look at this metric. This is the percent of heifers changing hands in feeder cattle and calf auctions across the countryside. It includes videos, it includes regional auction markets, and it even includes direct trade. And what you're seeing as we look at this fall calf run, really from Labor Day on forward, we're seeing slightly more heifers with this black line in 2016 going to sale barns relative to last year. And even though it's not on this graph, the first couple data points in January are showing a little bit of growth as well. So what it means is those cattle producers, cow-calf and stocker operators are seeing more heifers trade hands across the countryside, and we should expect by the time we really get into second half of 2017 that we'll see some more consistent year-over-year growth in this percentage. And it's our estimation that by next year we'll really see heifers as a percent of fed slaughter somewhere between 34 and 35%. So as we kind of put two and two together now and really try to think about what this means from a total cow standpoint, from a beef cow standpoint, is what it really means is our biggest growth year over year is behind us. We grew this cow herd 1 million head year over year into 16. Our estimation is that report that comes out next Tuesday will show an 850,000 head growth for 17. And then as we go forward, it's going to moderate. We still expect some growth in 18, but then the trend's going to get a lot flatter as we look to 2019 and 2020. What it'll mean is from these lows back here in 2014, we'll have grown the U.S. cow herd roughly 2 to 2.5 million head as we get to the peak in this cattle cycle. And so when we talk about the factory being slow to shut down, this is exactly that. As we talk about the combination of margins, which Mike will talk about a little bit later, a big influence in that being input costs, the other side of it being calf prices, we're in a situation where the cow herd's still growing year over year as we look to not only 2017 but 18 and 19, but at a much slower rate, getting back to a stabilization pace And then depending on the cost of those inputs and the total margin situation being faced as we look 2, 3, 4 years down the road, potentially even reverting to the contraction side of the cattle phase. What it means for you as cattle producers is there's going to continue to be more competition out there for buyers' dollars. We have more calves outside of feed yards than we've had at any point since 2011. And again, this is based on our estimate for what we're going to see in the U.S. Cattle Inventory Report. But as we really look at these numbers critically, you're probably sitting here saying, well, wait a minute, Lance, from the lows in 15, that's bigger than the growth you're showing up to this point in time in the cow herd. How can we have more cattle outside of feed yards than we have growth in cow herd? Well, the biggest thing we need to recognize is that we went through this period and we were coming through these early parts of this decade, we were sending a much higher percentage of calves directly to feed yards. As we've seen feed prices cheapen up, as we've seen these market prices decline, we've seen more pounds being added to these calves outside of feed yards. And as a result of that, we've got some residual of some older calves as we transition from the lows into what we expect to see in the January 1, 2017 number next week. What it means is we got more cattle in the calf phase being sold out of ranches. We got more cattle in the stocker and backgrounding phase as well. And so as we work through this system, that's going to be very important for you to consider, and Mike will touch on it more as he talks about marketing and risk management, the higher rate of retained ownership, and the hesitancy from feed yards to really own cattle for a long production window, to really try and shorten up their length of production and be able to turn dollars over faster. Those all have implications for us as we think about what happens in these various segments. As a result, as you would expect, steer and heifer slaughter is increasing as well. This last year, we saw 1.5 million head increase in fed slaughter. Next year, closer to 850,000 will be the year-over-year increase. And then again, just like the cattle numbers, the increases moderate going forward. But again, getting back to levels that we were used to seeing at the turn of the last decade. As we think about that, that obviously has implications as we talk later in this discussion about the demand standpoint and how do we move those additional pounds, which I think is really the root of a lot of folks' concern in the marketplace as we think about the cow herd expansion, as we think about the expansion going on in a lot of the other protein segments, and how we're going to move all of this meat, not just in the domestic market, but globally as well. As we think about this, this is a tweet that was brought to my attention by Dr. Glenn Tonser at Kansas State University, and I thought it was really applicable to this discussion. When we talk about agriculture, I think this is very fitting. Science tells us if we can do something. Society tells us if we should do it. And this was a tweet from the Center of Food Integrity, obviously more than 3 years ago. As we think about this, it's very true to the commodity business. And here we got a variety of different commodities. And you'll notice we got cattle, milk, hogs, the grains, even metals and energy. And when we think about the commodity business, science tells us all the time how much we can produce. And if you think of all of these commodities, they all have that same thing in common. Science and the science behind production oftentimes allows us to increase production in response to economic signals to a level that far exceeds demand. And all of a sudden society steps back when you think about that comment mentioned on the previous slide, and society tells us if the science and the production levels that we're making because of that science are too high, then they're going to correct the market values to the point that causes us to tap the brakes or maybe altogether shut down production. You've seen that very clearly with crude oil as it put in its lows. In fact, its all-time lows 79% below its highs that we saw just a few years earlier. And now you're starting to see it translate even in the agricultural markets. We've had record grain production, but it's come at the expense of prices that were 64% below their highs just 3 years earlier. And on the cattle side, we're still realizing our price breaks because in a lot of ways we are still realizing the supply increases. The full extent of our expansion hasn't reached the market just yet. The market's already given us a signal to start slowing that production with the extreme price breaks that we've gone through in the last 25 months. But we got to recognize that this marketplace is telling us there could potentially be more risk out there. And a lot of factors come into play when we start to realize, is this the bulk of those price declines as we see them on this graph today? Or is there risk deeper and harder in this marketplace going forward? And I think as we look at it at CattleFax, we feel very comfortable when we look at this graph in saying that we feel the bulk of those price declines are indeed behind us. But we also recognize that there is easily another $10 per hundredweight and maybe as much as $20 per hundredweight risk to the cattle markets, specifically as you talk about live cattle and feeder cattle futures as we go forward and we try to realize the additional supply that could be ahead of us in this marketplace. And so as we think about this, one of those messages that's been out there when we talk about demand is this idea that there's this mountain of protein that we have to chew through. And when you look at this graph, it shows very clearly that, yes, we have more supply coming to us, not just from a beef perspective, but also pork and poultry. And that's what's rolled up in this graph. But you'll notice, even with record high pork and poultry production today, and that's total production, and record high beef production likely coming to us at some point between today and 2020, when we subtract out the export markets, add back in the imports, and then divide it by the number of mouths we have to feed in the United States, this supply isn't unmanageable. We're basically talking about production levels that we had consumed on a per-person basis in the U.S. just as recently as ahead of the recession. What killed us from a market perspective was how dramatic this increase was in 2015, and then beef really added to this increase as we look to 2016. As we go forward, 17, 18, and really into 2020, we expect all three major proteins to be adding to this, but at much smaller levels than they had in the previous few years. But as we look at this going forward, absolutely it's a reason for us to be concerned, but in our opinion, not a reason to be overly fearful as we try to navigate this marketplace. On the beef side, it's another very similar picture. In fact, if anything, it looks a lot more manageable than the earlier picture. We're talking about beef consumption levels on a per capita basis, getting back up to 57 pounds per person in the next 2 years, likely approaching 59 pounds a person by the end of the decade. But we're talking about levels these next 2 years that are very similar to what they were in 2011, 12, and 13. If we think that we're also going back to very similar demand levels, a little bit down from the all-time highs last year, and we're operating at these type of supply levels, what it suggests is retail prices probably have risk back to the low $5 on an annual basis. For perspective, the all-time highs in retail price were in July 2015 at $6.15 a pound. And so we're going to get that lower price point. We're going to get it at retail, just like we already have realized in the cattle and wholesale beef markets. But what we need to recognize is retail prices move slowly. And I know it's been a point of frustration across the industry for a lot of cattle producers that we've captured a much smaller percentage of that retail price. But what's interesting is we're not in a boat that's altogether different than what's gone on in the hog or the chicken market. Each of them have seen their share of the retail dollar decline as well. And what's interesting, though, is as you look at 2016, each of these sectors has been able to recapture a percentage of that retail dollar. And we expect that to be the case, but likely not breaking this downtrend by any significant measure on any of these proteins until we see some more stabilization across the marketplace and a comfort level across the marketplace that we can move the additional production that we're making today and going to make going forward into more global markets. And I think that's an important point of differentiation for us to keep in mind as we think about these markets, because we got a price disadvantage still on our hands in the beef industry. When we look at USDA prices for beef against our competing protein friends, we still have a very heavy price disadvantage in the marketplace, even amid the declines. And what we're looking at here is the beef price relative to pork and chicken breast on the blue lines and the left-hand axes. And what you'll see is beef is still sitting here at a price premium that's almost 2 times the value of a chicken breast and 1.5 times the value of pork. Now on a broiler, a whole bird basis, it's more like 3 times the value. Just to get back to where we were in that 2011 to 2013 window, we got to see some pretty hefty declines. And again, it's very interesting when you look at this marketplace, broiler, chicken breast, and pork prices have all been very stable over the last 3 years. They've experienced a lot of their price declines early in this marketplace. And so if beef prices are going to come back down to build ratios at these levels, what we're again talking about is beef retail prices back at the $5 a pound level. What that means, with December retail prices right around $5.45, we got another 45 cents risk to this market at least. What that means is there's going to be less dollars to share as an industry. But what it also likely means is that as cattle producers, whether it's cow-calf or all the way up through the feedlot segment, we're likely to see some of these relationships and extreme relationships relative to market share, relative to bargaining position, get more competitive. And the beef producer able to command more of those dollars back in their pocket. And so as we kind of think about this, this isn't all bad. The average consumer, from an income standpoint, the median guy, the guy in the middle of the income bracket, has not seen his income situation change by any large degree over the last 20 years. This is U.S. median income, so this is the guy right in the middle of it all. Middle income America, as we like to talk about it. And what you'll notice is, yes, his income situation in 2015 is considerably better than it was at the worst part of the recession. But he's not doing that great if he can say, well, I made the same amount of money, actually a little bit less, in 2007, the same as I did in 2006, and really, on average, the same as what I did the end of the previous decade before that. As we think about that, these are the consumers, they aren't buying the high-end steaks, right? They're buying ground beef, they're buying chuck roast, they're buying stew, and a lot of these items, as beef priced in record highs, priced them right out of the marketplace as beef consumers. As we think about this, it also meant that in a lot of cases, eating out at restaurants wasn't the easiest thing for them to do either. And unfortunately, we're seeing some price disparity, not just across the beef complex, but also across the various segments servicing consumers. As we look at this, this is simply looking at the amount of inflation, we call it the Consumer Price Index, for food away from home, aka restaurants, versus food at home, the stuff we're buying at grocery stores. And what you'll see is the dark blue line signifies the year-over-year price change on a percentage basis of that grocery store food each and every month. And what you'll see is this point where these two lines intersect is basically January of 2015. And since January of 2015, grocery store prices have been able to actually deflate, while restaurant prices have held relatively steady. And if we were to actually just zoom in on this portion of the graph and set the starting point at that January 2015 level, what it actually means is retail prices, or I should say restaurant prices, have increased 4.5% in 2 years' time. Grocery store prices have been flat. And so again, as we look at this market environment, what's causing that? Well, what's really causing that is As we look at the retail segment, they've been able to pass the price break on to consumers a lot more easily on average. And this isn't just beef, this is all food. And as a result of that, they've been able to steal market share away from the restaurant business. Why haven't restaurants dropped their price? Well, there's a number of reasons. One is the growth in number of restaurants since the recession has actually outpaced the growth in our U.S. population. And so there's more restaurants fighting for relatively fewer consumers. The other side of it is the restaurant businesses, maybe unfairly so, felt more pressure from the standpoint of the arguments for a raising of the minimum wage in a lot of major population areas. They've also felt a bigger burden from healthcare costs and other administrative costs in doing business, and as a result, they felt pressure to keep their menu prices flat. What it's resulted in is in December, their customer traffic numbers and really their same-store sales numbers were down as much as 4% year over year. Well, on the retail side, we're seeing more advertisements for beef. We're seeing much lower retail featuring prices, and it's those advertisements that have been able to drive year-over-year increases in beef sales at the retail level. And we expect all of those trends to really continue as we look into 2017. Now, we talked a lot about exports, and as we try to get a bow around this part of our discussion today, what you'll see is we're in a market environment that's very friendly to us as a cattle producer relative to trade. We saw 11% decline in imports this year, year over year, as we've seen our cow slaughter increase, and we've seen Australian cattle slaughter and beef production decline. We expect a continuation of that trend into 2017, and likely sometime in 2018, we're actually going to get back to a position where we're going to be a net exporter again and see this blue line start to cross over on a monthly basis relative to the red import line. Exports really ended the year on fire. Up 12% for the year is likely where we're going to end 2016, and we expect a 5% increase next year. Two of our biggest markets from a growth perspective were in the Southeast Asia region, up 19.5%, 20% for Japan, and 38% for South Korea. Even though the dollar's been strong, we've seen huge breaks in our domestic protein prices, offsetting the strength in the dollar that we've seen over the last 60 to 90 days to a certain extent, and allowed beef to still be very price competitive in these markets as these protein consuming countries and very big beef consuming countries in the Southeast Asia region have really struggled to get product from Australia. And we expect ourselves as a U.S. beef industry to still be in the driver's seat as we look at 2017. I know there's been some concerns about NAFTA and the decline volumes that could come from TPP not being a thing of the future anytime soon, but a lot of those price effects and a lot of those market effects probably aren't going to pay us a penalty in 2017 if they are to do so. They're likely to come farther down the road, 2018, 2019. And so one of the things I know this audience likes to know is what is our price call for next year? As we look at the fed cattle markets, we think they're going to average about 110 for next year, with highs very similar to where we've been trading recently in the low to mid 120s. But risk still exists in this marketplace back to the 90s as we get to the second half of the year. Yearling fed steer price, 130 a hundredweight. Calf prices, 150 a hundredweight. Bred cows on a U.S. average basis, about $1,300 a head. And utility cull cow prices averaging about $65 a hundredweight. As we think about a price forecast, we got to recognize that in every one of these cattle markets, we're in a situation where last year we did some damage technically to these markets. And as you look at this in particular, the support levels that we broke, and not just the feeder cattle, but the fed cattle and calf markets as well, suggests that we got to recognize that the downside on these markets is back into these old historical trading ranges. As we look at the supply situation we're in, it shouldn't be altogether shocking that we're going back to some of those old levels. And so while we've given you these annual averages, we should recognize that they could have very wide ranges around these averages still as we work to this market, really carving out its longer-term lows. And so with that, I'll try to make the transition here and turn this over to Mike and give him a chance to talk to you a little bit more about how we can manage some of that price risk going forward here. So Mike, let me turn this over to you.
Thanks, Lance. So obviously, as you think about what Lance has just kind of gone through there in terms of the information, we've provided that fundamental foundation as we assess things on where we feel like the market's going to be, trading at from that annual average, as well as when we look at it relative to the ranges around the market. I think what we've learned in here as we kind of go forward, or excuse me, look back, is that there's a lot of moving parts in terms of the market. And part of what we want to share with you and those who are heavy users of the CattleFax information, you read this a lot in terms of our weekly publications and monthly publications, but we have a lot of emphasis on looking to manage risk. And part of risk management is just understanding your operation, understanding who you are as an individual within your operation. And we like to look at things and say we should be identifying a market risk profile. And really what that is you get into a little bit more depth here in just a couple of minutes, but it's a process to create a no surprise environment. And that's ultimately what we're looking for as we start to try to manage risk, because as we've learned in the course of the last few years, there's surprises to the market, sometimes good, sometimes bad, but there are certainly surprises to the market. So we wanted to try to be in a situation where we have a process in place that allows us to have no surprises. Now, within that, you can get into some more depth, if you will. What I mean by that is, looking at how much do you want to risk? Is it a percentage of, say, your net worth? Is it a percentage of your total, or are you looking at it from a total return on investment? Are you looking at what your banker thinks you should risk? Those are all factors that you can certainly dial into, and part of this whole process, if you have more interest in learning more about this, we'd be more than willing to sit down with you and talk through it. For the sake of time tonight, though, we're going to go ahead and move on and start thinking about strategies in terms of managing risk here for 2017 from a stocker and cow-calf sector, as this is a cow-calf webinar. Clearly, seasonality plays an important role to risk management, and that seasonality, as we've talked over time, comes back to the live cattle, the fed cow seasonality, and then how that correlates back to the value of feeder cattle and or calves. So we have to have that as a key component of our risk management, and we'll get more into that in just a couple minutes. As you look at the mechanisms to market your cattle and or manage risk, there's multiples out there. You have to find one that fits your program the best and move forward with it. As you've heard for many of you on the calls, I look at some of these names for many, many years. Obviously, you've got to know your cost of production. You've got to know your break-evens, and that's just rule number one as you start to think about managing risk and managing your margins. But that concept of seasonality, you think about what Lance just talked about in terms of the market and suggesting that the market's going to average 110 for fed cattle in 2017. And he gave the range of this low to mid-20s with risk back into the 90s. Well, the seasonal around the market really implies that those lows are going to come somewhere out there in that summer, early fall period. What we want to identify, if we think about a spring grazing operation, as we look at this chart, and this is really data going back for 35 to 37 years worth of data, and all we're trying to attempt to do is to simplify things for those that are looking to manage margin. And step number one is to understand that feeder cattle are highly correlated statistically to live cattle. In this example, we're measuring March feeder cattle and August live cattle. There's a very strong statistical correlation. So knowing that, when you see or experience something that's changing in the market, and this is looking at the August live cattle futures, if we start to see where there's a change in this trend, a change relative to this moving average, which in this example is a 20-day moving average, that should alert you at a very high level that something's going to be changing to the value of feeder cattle as well. Whether that change is going up or whether that change is turning back lower. We know, again, that there's a strong correlation between the value of feeder cattle and live cattle. We look to the live cattle to be the driving force of if there's going to be something more significant developing in the marketplace. So as you think about your business in here towards the spring, and we're really in this example and looking towards the spring window, we're thinking about those winter grazing operations and or backgrounding operations. Most of you that purchased your calves in the fall, keeping in mind that was the low of the market there in October and we transitioned coming into November, most of you have margin on your cattle. Just where the market's recovered back to. Many calves trading between $1.25 and $1.40 in that October, early November window, and yet today we've got spring feeder cattle values sitting out there in that same area of say $1.25 to $1.30. So most of you are profitable at this point in time. The question is, do I pull the trigger? Well, you could argue today that as long as the live cattle trend for August live cattle is trending up, you don't have to be quite as concerned about losing the value of your feeder cattle going forward here. However, the minute that this trend turns over, then the red flag is raised. There's definite risk, and we should be locking down margins to the fullest degree that we can. Now, having that market risk profile might put you in a position that if you've got 2 loads of feeder cattle coming off of wheat this spring, you may be laying off risk on 1 load today just because of the margin that you can capture, and then the next load you'll lay off when we see something change within that trend. That's the way you put the information to work. It's the same concept as we look in here deeper into the late summer, early fall period when we're going to be looking at the summer grazing operations. It's the same concept. You have a very strong correlation in this example with August feeder cattle and December live cattle. That correlation suggests that we should put a lot of focus and emphasis on what that trend is of December live cattle. And if something's changing with that trend, then we've got to acknowledge that something's going to change with the underlying value of those August feeder cattle. So that's really a very elementary foundation of trying to identify the right criteria and variables to make a simple risk management decision. There's a whole other host of things that we could look to get into, thinking about option strategies to protect equity or looking at forward contract, basis contracts, all those types of things. But in this setting, it's important just to simplify. And the best answer that we can give you today is that your risk to the value of your feeder cattle is limited at this point as long as the live cattle trends are turning, are pointing up. The minute that they turn over and break these trends, then the risk becomes significantly higher, that the trend of the feeder cattle are going to go lower. And ultimately, that's going to be compounded to a certain degree. And what I mean by that is that then you take it to, well, how much risk? Well, that's dependent upon how much money the cattle feeding sector has lost. You can see as we transition from 2014 into late 2015, where we had this significant shift in cattle feeding margins, making $350 a head to losing in some instances at the lows there in December of 2017, December of 2015, $550 a head. Clearly, when you look at the red line, the right axis, there was going to be a significant change in the value of feeder cattle. This is measured by a year-over-year change. If the blue shaded area can improve, which is margin, then as the trend changes for live cattle, you're probably not going to have as much risk to the value of feeder cattle. Although it'll still be a downward pressure, the risk won't be quite as severe. But if we shift back in where this blue shade area is trading in the negative territory, where cattle feeders are losing money, then that risk is going to certainly increase as we think about the value of feeder cattle. For those marketing in this spring period, I think it's pretty straightforward just to measure what the August and October live cattle trend is. If you're looking far enough out front into your summer grazing operation, it becomes a little bit more of a challenge, because we could see a downward trend, which is seasonal, into the summer, and then by late summer see the market recover back. Obviously, the last 2 years that hasn't been the case, but the longer-term seasonal would suggest that. So certainly when the trends turn over for those late summer, early fall yearling cattle, we need to look to protect equity in that environment. For that unknown, as Lance alluded to, that the potential of the market on the Fed side moving back into the 90s. If that's the case, there'll be red ink at the cattle feeding level, and that will create more risk to the value of feeder cattle. Now, as we think about the relationship here for the cow-calf operation, a little longer-term vision, obviously, one time a year when they look to market those animals. This is what we've kind of got described in terms of margins as you look forward here into 2017 and the end of the decade. But keep in mind the range around, if you're a high return producer versus a low return producer. As we always say, you've got to get a handle on your cost structure to really be able to measure what your returns are in the marketplace. Now, thinking about things a little bit shorter term, as we look at the feeder cattle market in here, there's a strong seasonal pattern when you look at things. That's that green dash line. That would suggest that, and I said feeder cattle meant to say calves, that would suggest that calves will move higher into the spring, and then obviously following the trend lower into the fall. This window, just as it was this last year, more times than not is the window you want to shy away from in terms of marketing your calves. We believe we're going to be in a seasonal pattern in 2017. Nothing to suggest otherwise at this point in time. Now, there are some barometers that you can track in here, looking at the spread between feeder cattle and yearling cattle. Typically feeders are at their maximum price level relative to yearling cattle here in the winter time frame, but then that spread narrows. So it gives you a benchmark to start to think about, well, if December live cattle are trending lower, and that implies there's risk to August feeder cattle, or September or October feeder cattle back towards 120, then you can start to kind of see, well, this last year we were depending on the period, a 4 to 10% premium when you looked at calves relative to feeder cattle. So this helps you kind of build some benchmarks. Even today, as you look at the fall feeder cattle futures, mostly trading in the mid to upper 20s, what you would be assuming for the value of your animals at that time frame. The other thing is just trying to take advantage of some of the strong tendencies of the market from the cow-calf level. And at the cow-calf level, it is a little bit more challenging to manage risk because there is a little bit more basis variability when you think about the marketplace. But that's in the context of futures or options. There are other risk management strategies out there that you can incorporate. It's not for everyone, but for those that do have this opportunity, they can look to incorporate this into their business and their operation. And that is looking to forward contract your calves for fall delivery, but sell them in the summer. And in this example, as we look at this as purely an average, when we define summer, we're really talking about from June into the first week of September. This is measuring the video data. And in this example, we're just measuring the auction values that you'd find in the fall time frame. Now, some of you may operate within the country to forward contract your calves in the country, and that certainly makes sense as well. The bottom line with this information as you look at things is that the average, and it's like every other seasonal that we know relative to the markets, 8 out of 10 years, that you're going to receive more for your calves by forward contracting them than by not. And that's the summation of the data. We don't have a full 10-year data set in here just because it starts to get a little bit crowded on the presentation, but it's an 8 out of 10 year seasonal when you go back and look at this historically. So we believe if you market your operation on a consistent manner in terms of you're consistently doing the same thing every year, you're not trying to outguess the market, then those returns will come to you over the long haul, and this happens to be one form of looking at risk management. Again, this is not for everyone. There's plenty of folks that will market in the fall at weaning, and they certainly do very well, but this is something that we can all take a look at in terms of assessing where there might be opportunities to improve our returns. And that will be something as we look a little bit longer term into the end of the decade with some of the things that Lance alluded to from a production standpoint. Calf values will have continued downside risk over the next few years just based on the cattle cycle itself. So with that, I'm going to go ahead and Dr. Hilton's going to walk through his slide deck and presentation. I'll be forwarding the slides for him, but we appreciate Dr. Hilton being with us with the Lanco Animal Health and all the support that they've given to us over time. So, Dr. Hilton, I'll go ahead and let you start.
Thanks, Mike. I appreciate that very much, and sure want to thank Lance and Mike for sharing their knowledge with all of us, and Elanco is sure pleased to sponsor these educational events. So what I wanted to talk to you tonight about was antibiotic alternatives, and you can hit the next slide there. The VFD is now about a month into being, and I just wanted to check in with some thoughts that we're getting. We're starting to hear some things out in the country. And one of the things when I've done these VFD talks, the first thing I do is remind producers and veterinarians that the VFD was driven by consumers. One of the goals of the VFD is to improve consumer confidence in our products. And as you can see by the numbers listed on this slide, nobody's very excited about these kind of numbers. It's disappointing that this is how the consumers think about how we're producing their food, for them. And one of the things that I would always talk about in the VFD meetings was that 98% of the population of the United States is not involved in production agriculture. So when those 98% of the population that don't understand what we're doing hear that 98% of all antibiotics used in livestock are used without any advice from a veterinarian, that's troubling to our consumers. And now we can kind of look at those numbers and say, maybe we should make a difference. And this is part of the reason the VFD was put in place. With the VFD in place, now only 30% of the antibiotics used are going to be over the counter. So we think that's a real step in the right direction. On the next slide, it shows a little bit of a time frame, a history of the VFD. And the reason that I wanted to show this is to, again, remind producers that this didn't happen overnight. This started back in 2012. And in fact, when I read the very first publications that came out from it, the rules were very burdensome back in 2012. And the good news is that through dialogue with producers, veterinarians, nutritionists, we had some real significant wins in this process. The VFD is much more veterinary and producer friendly than it was back in 2012. And the next slide shows a little more about this. So when the VFD was first introduced, again, I didn't talk to a single veterinarian or producer that was positive about it. Everybody was pretty negative on the thing, more paperwork, more regulation. But once I started reading more about it, looking at some of the significant wins that we got on this thing, listening to experts like Dr. Mike Appelle talk about it, I changed my tune and I really did become positive about the VFD. Veterinarians that work with livestock producers want to be on the asset side of the ledger. If our beef producers and feeders aren't making money, then we're not successful either. We want them to be successful, and we want to be someone that helps them be more profitable. So if we can help the producer reduce expenses in their beef business, we want to do that. My grandpa was one of my real heroes in life, and one of his famous quotes was, "If you don't spend a dollar, it's all profit." And I've always remembered that, and that really fits most of the mindset of most of the cattlemen that I deal with, because if they can reduce unnecessary expenses, they're going to increase profitability of the operation. So to me, being the optimist, I think the huge positive of the VFD is for beef producers and feeders. It's a chance to sit down with your herd health veterinarian, your nutritionist, examine your entire antibiotic usage in your business. And so that may cost $100 on consultation with the veterinarian or nutritionist, but if it ends up saving you $1,000 or more of antibiotics that you don't even need, that's a real win. So on the next slide, I guess the best way that I can make a point is by sharing a story. So I've done a lot of these VFD talks, and I did one this past fall. And I was about halfway through my talk, and a producer raised his hand and said, "So now I have to pay a veterinarian to get a piece of paper so I can buy a product that I've been using for 50 years. Well, I tried to explain that maybe, just maybe, he did not actually need the antibiotic. He stated, "Well, of course I need it. I've used it for 50 years, and it's kept my animals healthy for 50 years. Well, most of the rest of the crowd kind of chuckled and laughed because they understood that he just kind of made my point for me. And after a few more bits of discussion, he and I had back and forth. It was very cordial. He actually smiled, and he realized, gee, maybe that product that he'd been using for 50 years wasn't necessary, and he was going to make an appointment with his veterinarian and get that taken care of. And in fact, about 3/4 of the way through the presentation, he realized all his questions were answered, and he says, "I'm going home now." And so he got up and left, which that was fine with me. He was very honest, but it was a fun story. But I think too many times we have products that become routine, and that's just a mistake in most situations. So again, being the optimist, I think this is a chance to be positive. On the next slide, I've written, the other reason we have the VFD is we want to decrease the amount of antibiotics used in livestock. The number one reason is improve consumer confidence, and number two is actually decrease the amount used. So first thing, you need to look at the label. Every antibiotic is labeled for specific diseases, for specific situations. If it's not on the label, it's illegal, and you cannot use it that way, and the veterinarian cannot sign it for something that's not on the label. The other thing is, does the product have current research on it that shows that it's cost effective? Ask for this information. Make sure the money you're spending is spent well. So if you're in the livestock business and the additional expense isn't justified, then you're not adding to the business. It's just an added expense. And no producer that I know of wants to spend money on something that's unnecessary. So I'm going to pick on one of our products. On the next slide shows Pulmotil. It's an excellent antibiotic, very effective in controlling bovine respiratory disease, which some people would call pneumonia or shipping fever, due to the 3 major bacteria that cause BRD. And so my question is, should it be used in all cattle at risk of developing BRD in the feedlot? Absolutely not. If you're buying high-risk cattle that have an extremely high probability of developing BRD early in the feeding period, using an injectable antibiotic labeled for metaphylaxis is the scientifically proven course of action to take. Using an antibiotic in the feed when we know that consumption will be highly variable in these high-risk calves just doesn't make any sense. Okay, so how about using Pulmotil on the opposite end, a group of high-health, fully preconditioned calves? Again, this would not be the place to use a feed-grade antibiotic. When the producer has provided excellent nutrition, management, environment, vaccines, these cattle should have a very low probability of developing BRD. So using something like Pulmotil would just be a waste of money. Now, if these calves in a week or so afterwards, we've had some terrible weather or some other thing, and we end up having 10% of these calves that are diagnosed with BRD, then Pulmotil would be an excellent choice to use. But to me, it's a very specific time that it would be used. I don't want producers spending money on things that they don't need to be spending money on. So on my last slide, I pretty much say, if you're a pessimist, the VFD is just another burdensome government regulation. If you're an optimist, the VFD is a chance to enhance consumer confidence and a chance to decrease reliance on antibiotics, especially those that have become routine. So to me, the VFD gives you, the producer, an opportunity to have a conversation with your herd health veterinarian, with your nutritionist, to make a plan to decrease overall antibiotic use, which will decrease the cost of production and cost of gain. And you do this by improving nutrition, environment, genetics, handling of the cattle. And the bottom line is you increase profitability. And that's what Elanco is all about, helping you increase profitability. Again, thanks guys for doing the CattleFax webinar. I thought it was just excellent information this evening, and thanks for letting me come and share just a bit too.
Thank you, Dr. Hilton. We really appreciate the opportunity for you to share that information with this crowd. Obviously, if you have other questions related to any of this, if you can't reach out to your own veterinarian, I'm sure there's Elanco folks nearby that you could reach out and talk to your local representatives from that standpoint as well. So make sure you do reach out to those people and get the information that you need to be able to make the right decisions. As we kind of conclude things in here with today's discussion, there's a handful of questions, and I think with what's going on from a time standpoint, we try to keep these kind of within a 60-minute window. This is Lance and myself's email addresses, and so for those folks that had asked questions, please jot these down and go ahead and email us, and we'll get your questions answered here as you send that email to us. But for right now, I think we want to hold off and not spend any more time in terms of tonight's discussion. Just a few things from CattleFax's perspective. There's risk management seminars, corporate colleges coming up this summer, our annual Outlook and Strategy seminar at the end of the year. But specifically, some of those things that we talked about at the risk management level, these seminars can provide more of that type of information for you if you're looking to become more engaged on developing a risk profile, looking to really manage your margins for your business as you look at things. And then finally, the next Trends Plus webinar will be Wednesday, May 24th. As Lance said, we do about 3 of these a year. We really appreciate the sponsorship and support that Elanco provides on these. Without them, they certainly wouldn't be done. So we really appreciate that, all that support. As Lance said earlier, we will be sending out the recorded version here within the next 24 to 48 hours, assuming that the technology works as we hoped it will. And so you'll receive that email, and that'll be archived out there for the next 30 days roughly on CattleFax.com. Which is the final thing that I would say. For those who are CattleFax members, we have a new website we certainly want you to engage with. If you're not a CattleFax member, we'd really encourage you to go to the new website. There's a new subscription component of CattleFax. We don't have to become a member. You can subscribe, and you'll get bits and pieces of information throughout the week sent to you that is actually free. So we really encourage you to take on that opportunity. And so as we wrap up things here tonight, we want to thank Dr. Hilton for his time and for Elanco's support, and for all of you that have stayed with us for this Trends Plus webinar. Please have a prosperous year here in 2017, and we will talk to you soon. Thank you very much.